Shutterstock Friday could be an exciting day for Wall Street, and I don't mean that in a good way. The Labor Department will announce its April employment report at 8:30 a.m., and in the topsy-turvy reasoning known only to Wall Street, a report that looks too strong could cause problems for both stocks and bonds. Right now, and until this view is overturned on appeal, good news is bad for Wall Street. And, conversely, bad news is good. The financial markets are expecting the Labor Department to announce that 190,000 new jobs were created in April, a big improvement over the disappointing 103,000 in March. And the experts are expecting the nation's average hourly earnings to have jumped 0.3% from March to April, up from the 0.2% increase a month earlier. If either of those figures, the jobs or wages growth, is better than expected, the bond market will probably react negatively and send interest rates higher. And stocks will be hurt. The U.S. government's 10-year note is already toying with the dangerous 3% level, and even exceeded it temporarily recently. And the government's 2-year note has caused even more distress. It rose to around 2.5% in recent days, which is the highest yield since September 2008. The 2-year note more closely shows the market's feelings about the Federal Reserve. And right now, the 2-year is telling investors that the market thinks the Fed will raise rates 4 times this year, not 3. There has only been one rate hike so far in 2018. The Fed met this week but didn't take the opportunity to hike rates. But it did have good things to say about business investment in the job market in a post-meeting statement on Wednesday. However, the Fed's statement curiously took out the reference to strengthening economic growth that it had used for some time. The feeling is that the Fed is status quo on rate hikes, 3 more this year, maybe 4. The most telling part about interest rates is the fact that they are rising and the Fed is worried even though the economy isn't booming. Our nation's gross domestic product grew by a modest annual rate of 2.3% in the first quarter of this year. The experts think the second quarter will be better. But they always do, until they have to downgrade their forecasts as the quarter moves forward.